Hello. In this video, we will be going over the lower of cost or net realizable value as it pertains to inventory. In the previous videos, the previous chapters, we learned how to record the cost of inventory using different inventory costing methods, whether it's FIFO, LIFO, average cost. Once that's done and you have your inventory on your balance sheet, at the end of the accounting period, companies are required to look at their costs that they have on their balance sheet for their inventory, and if their expected benefit of the unsold inventory, which is the inventory that's remaining on their balance sheet, is estimated to have fallen below cost, so below what it's recorded at, then they have to write down the inventory amount to the expected benefit of that inventory. So that's not necessarily market value. It's kind of like market, but if we think that the amount that's shown on the balance sheet, the cost amount of inventory that's shown on the balance sheet is too high because eventually we will not recoup that cost, then the inventory needs to be written down. And there's two different ways to do that. And it really, your approach to how to write down your inventory depends on which inventory costing method a company uses. So the first one, the first way to write down the inventory write down is taking the lower of cost or net realizable value approach. And that is used when companies use FIFO, average cost, and basically any other method besides the LIFO method or the retail inventory method. And we'll go into retail inventory methods in different later videos. The second measurement approach is the lower of cost or market, and that's really if you do use LIFO or the retail inventory method, you write down your inventory based on the lower of cost or market. No matter which method is used, they'll both reduce the reported inventory and they will both reduce the net income because the way we write down inventory is credit inventory, debit cost of goods sold, which would reduce your net income. So let's go through, this video is going to go through the first approach, which is the lower of cost or net realizable value. So that, again, this is when you use the FIFO, average weighted cost, and anything besides LIFO and the retail method. So the net realizable value is equal to what we think the inventory will sell at, so the estimated selling price, minus any cost to complete, dispose, or transport that inventory. So it's really the amount that a company expects to realize from the sale of inventory after these things are done, after it's disposed or transported. And then, so you're going to calculate your net realizable value. And at the end of the year, the company compares the cost of its inventory that's currently on their balance sheet to the net realizable value. If the net realizable value is lower than your cost, so let's just say this is 1,000 and this is 900, right? The cost is 900. Then, oh no, it's the opposite way. Oops. If the net realizable value is 900 and your cost on your balance sheet is 1,000, then you need to reduce your inventory to the net realizable value. So our inventory would need to be reduced from 1,000 to 900. However, if your cost is lower than your net realizable value, then it's already at the lower of cost or net realizable value because it's already at the lower amount and no adjusting entries needed because that's already what the inventory is recorded on your books at. There are three different ways that a company can determine how they want to group their inventory and then decide to do the lower of cost or net realizable value analysis. And the first way is they can look at item by item. They can look at individual items and look at each inventory item and say, okay, here's my cost for this piece of inventory, and here is my net realizable value, and which one's lower. So we're going to go through an example. And so this says the general supply company has 5 inventory items on hand at the end of the year. The year-end cost determined by applying FIFO cost method. So therefore we know we need to use the lower of cost or net realizable value. So the year-end cost and net realizable value for each of the items are presented below. Okay. And for items A and B are a category of similar items, and items C and D are another category. We'll get that to in later slides. So the first way to do this analysis is item by item. So here we have item A, the cost is 50, net realizable value is 85, and we take the lower of that, and that's 50. Then we look at item B, right, our other piece of inventory, and we have a cost. The cost, meaning that's what's on our books for, is 100. We calculate the net realizable value is 90, and we take the lower of the two, so that's 90. And so on and so forth. We do that for all of our inventory items, item by item, right? And so you do the analysis for each one of these individually. You look at the cost versus net realizable value, and you take the lower of, and then you add them all up into this column right here, by individual item. So, and then you look at your cost, which is 415,000 for all those pieces of inventory. And this lower of cost or net realizable value ended up being to be 395,000. So our net realizable value is lower than our cost, and therefore we need to reduce our inventory by 20,000. This is what it is. This is what we have in our books right now. This is what it should be. So we need to reduce it. And the way we do that is if you just do a T account, it's on our books for 415,000. We need to bring down our inventory to 395. So therefore we need a credit of $20,000 to record a credit. And so here our credit is inventory 20,000, and the debit is the cost of goods sold for 20,000. And that's how we reduce our net income. If the write down of the inventory required is substantial, like unusually large, then instead of debiting cost of goods sold, we would debit a loss account. And the problems, if you encounter that problem, it would tell you that this is substantial or unusual. A second way of doing the analysis is grouping your inventory items by category. So doing individual by item is very tedious. Most large companies or medium-sized companies are not going to do that because it would require a lot of work, a lot of manpower, and a lot of money. So another method to determine which one's the lower cost or net realizable value is to group your inventory by categories of similar items. So let's just think of if you have like a Pacific Sales kind of store. I don't know if you guys know that. They sell various kinds of appliances, anything you can imagine. So maybe they would categorize, okay, here is, we're gonna look at our analysis for all our refrigerators are one category, all the ovens are a different category, all the washer and dryers, washing machine and dryers are a third category. So that's what when companies group these by similar items of categories, that's kind of what they mean. So in this situation, this company, we're told that items A and B are a category of similar items, and then items C, D, and E are another category. So the way we would do this is we would look at in item A and B, right? And the cost is 50 and 100. So we look at that total. That's our total cost we're looking at. And we look at the net realizable value and add those up. And um, and you look at that. And so you say, okay, my total for cost for this category is 150. My total net realizable value for this category is 175. So the lower of the two is the 150. And then you look at your next category. So we just did this one. We just did that. So now we look at inventory items C, D, and E, and we add up all the costs for C, D, and E, and they add up to 265. We add up all the costs for C, D, and E. We add up all the net realizable value for C, D, and E, and those equal 256. And so the lower of between 265 and 256 is 256. So now when we look at what adjustment do we need, if any, we say, okay, here's our lower of cost or net realizable value by category. And we take the 150 from this first category and the 256 from the second category, and we get a total of 406. And then we compare that to our cost by category. Well, it doesn't matter by category or not, but the total cost is 415,000 versus 406. And so the lower of the two is 406. Currently, we have inventory in our books at 415, so we need to reduce it by $9,000. We need to reduce our inventory. And again, we're just going to look at what's the inventory in our books, which is the cost, the 415. It needs to be 406,000, so we need to reduce our inventory by 9,000, which would be a credit to inventory, and the other side is cost of goods sold, because this is not substantial or unusual. If it is, again, we write it down to a loss account. And then finally, a third way a company can analyze the lower cost or net realizable value analysis is just looking at their total inventory. And here we see our total cost is 415, okay? And you just look at the net realizable value, you look at each item and you add them all up in total, and we get 431,000 is the total net realizable value. So here, our cost is going to be the lower of the two, between 415 and 431. Our cost is 415, so we have no adjustment because it's already at the lower of cost or net realizable value. And so let's just do this quick concept check. And it says the following information pertains to one item of inventory of the Forge company. There's a cost of 270, so that's what's currently on the balance sheet. This is what we currently have on the balance sheet, it tells us. Replacement cost is 225, selling price is 292, and cost to sell is 52. Well, we need to look at it tells us to look at the cost, lower of cost or net realizable value. So the net realizable value is going to be your selling price that you think you can sell the inventory for minus any cost to sell, any cost to get it ready to sell, whether it's a disposal cost, a transportation cost. It could be different costs to get it in a state that we can actually sell that inventory. So we're going to look at our cost. Our cost, it tells us, is 270. Our net realizable value is going to be our selling price minus the cost to sell, which equals, I think that's 240. And so we look at this and we say, okay, we need to look at the lower of 270 to 240. So the 240 is the lower of the two. And so it should be valued at B, right? Let's see, survey says yes. And the way we would do that is we would debit cost of goods sold 30 and credit inventory 30. The problem doesn't ask for it, but that's how to get from 270 down to 240. We would have to reduce our inventory by $30.